I'm Joe Galvin, Chief Research Officer at Vistage, here to share the insights and analysis from the Q3 2024 Vistage CEO Confidence Index. Our latest quarterly survey captured the sentiment of over 1,600 CEOs in early September. The results show that the CEO Confidence Index rose slightly. It should be noted that the survey closed the day before the Fed's interest rate cut of 50 basis points. Over the next 10 minutes, we'll explore the most relevant data to inform your decision-making for the next quarter and beyond. In September, the Vistage CEO Confidence Index improved to 85.1. While sentiment about the current economy remains pessimistic, there is some optimism in the future of the economy, no doubt due to expectations of the long-awaited interest rate cuts. Following the close of the survey, the Federal Reserve did reduce rates by 0.5 point. And while this is good news, 46% of our members reported it would take a full point reduction or more to impact their business. Inflation remains a challenge. Even though the rate has slowed, the compounding effect has made everything more expensive. With all these factors in play, we look to our partner ITR Economics for their expert perspective. Today, we welcome back our friend, Lauren Saidel-Baker, Senior Economist at ITR. Lauren is the co-host of the ITR By the Numbers podcast and has been interviewed on NPR Marketplace, Bloomberg, and many others. Many of our members have had the opportunity to see her at Vistage Executive Summits, most recently in Orange County and Charlotte. We're grateful to have you here to help us connect the CEO sentiment captured in our confidence index with ITR economic analysis. Lauren, welcome. It's great to have you back.
Thanks, Joe. Great to be here.
Yeah. Lauren, the story remains the same. Inflation, interest rates, the cost of labor. What does your analysis show?
Yes, it is more of the same since last we spoke. As you mentioned, the one bright spot is that 50 basis point interest rate cut that we saw from the Fed. I don't think the Fed is done yet. So they are saying another 50 basis points through the remainder of this year. That would get us up to that 100 mark that you quoted earlier. The market is expecting a little bit more than that. I think there's a chance we do see additional cuts into early 2025. But I do want the folks watching this to be prepared that we might not get that full 200 that the market is currently pricing in. We at ITR do see more inflation on the horizon. So while disinflation is the name of the game this year, and certainly for the remainder of 2024, by next year, inflation will likely be coming back. That's going to limit the amount of cuts the Fed can do. So don't wait too long. If you're looking to invest, if you have that project that's going to increase your efficiency, I'm sure we'll talk about people and the tight labor market in just a minute. Those investments can still be worthwhile, even at this slightly higher cost of borrowing. It's not worth waiting and missing all of that time, if you have downtime now to be installing equipment, training people up on it. Think, what does 50 basis points, 100 basis points really mean if you're in place and ready to go, ready to hit the ground running in 2025?
So the concept is be prepared to act now, even though the rates may fall a little bit more. You anticipate into next year, as those rates fall, inflation is going to kick up again.
Very likely. We're watching inflation for a number of reasons, right? We have some fundamental factors in place. We do have higher wage inflation than we've become accustomed to over the past decade or so. So that pricing pressure for people, right, that talent is going to remain very limited. That's going to have a margin pressure for a lot of businesses. So again, efficiency is the name of the game. Make sure those investments are worthwhile, right? That you're not just throwing money at a problem without a strategy here. But AI, automation, those can really help folks get ahead. Now, as I quote the timing here, I want to be clear. I'm talking generally about the industrial production index. That's where we see a little bit more flatness through the remainder of this year, but rise again by 2025 and 6. Not every business is a perfect correlation to the industrial economy. Know where your lead or lag time falls and use that for your appropriate planning.
Well, you touched on the labor market, so let's go there. We see that unemployment rates are slowly climbing. We see retention rates are up in our community, and we see 50% of our community will be increasing headcount over the next year. Now, that's below the numbers that we saw during the 2010s, but it still shows that organizations are looking to grow and add headcount. Additionally, 30% of our CEOs say it's easier to hire now, as there are more candidates of better quality, all due to the slowdown. They also think they're getting better at hiring and have seen wages stabilize. With these factors in play, how do you see the labor market evolving?
Retention is still really something to prioritize, even with this slightly looser labor market that we're seeing currently. I want to keep that looseness in context. Yes, there have been a few big revisions to the non-farm payrolls number, but overall, this is still a tight labor market. It still is an employees market. if we look at the ratio between unemployed workers and job openings, for a while, that was a 2-to-1 ratio, 2 job openings for every 1 unemployed person. Now that gap is narrowing, but it still is not quite back to a 1-to-1 ratio. We have about 92% of an available worker for each job opening. So keep in mind that while things feel easier this year, we're still not back to a historical balance. It still is not easy to hire. So you're going to want to keep the foot on the gas pedal in terms of these hiring and recruitment efforts. More than anything, retain those existing A-team players, your top talent. It's just so expensive to find a new candidate, hire them, get them trained up to speed to where someone had been productively working. So I really do see a little bit more easing, let's say, through the remainder of 2024. But this is not a sea change. This is not candidates knocking down your door. You will still have to be very intentional in those hiring efforts. But if you can hire here for the remainder of 2024, you probably will continue to see more qualified workers. You might be able to lock in some labor costs this year that will get you through 2025 and beyond.
Lauren, as we look out to 2025 and beyond, and we see the pending growth cycle, hopefully maybe initiated by the Fed rate cuts, how is that going to change the dynamics of the labor force? Are we going to be back in the frenzy we were 2 years ago, where we see exploding quit rates and everybody getting pay raises? Or will this be a more normal type of wage escalation environment?
Hopefully it won't be quite so bad. Again, the pandemic was just like taking the snow globe and shaking it up. So we had a huge disruption in the labor market with the pandemic. We're still feeling some of those echo effects, but as you said, demand will really be increasing in 2025 and beyond. Not just for those rate cuts, but we see the fundamental factors really supporting this. The leading indicators that we have been following for a long time show that natural turn up in the business cycle. So competition very likely to get tougher again next year. And our demographics here in the United States, they don't support a huge glut of workers coming onto the labor market. There just isn't some pressure release valve, so to speak, of people who could come onto the scene. So I really think it will take automation. It will take very intentional investment in maybe AI, but something here to make our workforce more efficient. That's what smart businesses will be investing in, because with these sustainably higher than historical wage pressures, that's going to be a margin battle. You need to increase productivity of your workforce if you're going to fight on margin.
Lauren, we're moving into strategic planning season now as we enter in the fourth quarter. And our members have shared that the timeline of their strategic plans is 3 to 5 years, which includes the upcoming growth cycle. But for the first time, 2030 is beginning to appear on that far end of the 5-year horizons. What are the investments SMBs should be thinking about now to be poised to take advantage of the growth cycle in the short term and protect themselves against what is coming at the end of the decade?
First, I would say don't let fear of the 2030 depression stop you from making the investment that you need over the next 5 or 6 or so years. This really will be a good growth cycle. You don't want to miss out on that upside. But you're absolutely right, Joe, that 2030 is coming into our horizon, and it's going to be important to get plans in place. Now, whatever plans those take for your business or for your individual finances, it's too soon to execute on them, but you do want the roadmap of how protecting yourself through the downside. If you're looking to sell the business, that takes some time. So you might want to get the wheels in motion a little bit sooner. Make sure that you can have your exit strategy in the time frame you're looking for. These things always take a little bit longer than we think they will. So I would say talk to your financial advisor. If we can help at ITR, we can put you in touch with someone who knows the strategy, right? Who knows the theory here, but have the plan in place. Don't press that execute button quite yet, but know where you're going.
Lauren, thank you for your time and your analysis. Our whole community always looks forward to hearing what ITR has to say at our events and our quarterly session with you to learn more about how ITR sees the market go. Your guidance and analysis will help the leaders of our community understand what to expect as we close out this year and begin to plan for 2025. We look forward to speaking with you again in December, and to everyone to join us again as we discuss the year ahead with our analysis of the Q4 Vistage CEO Confidence Index. That survey will be in the field in early December. I'm Joe Galvin, Chief Research Officer of Vistage. Thank you for your time. We'll look forward to your participation in our analysis as we go into the fourth quarter.